This is TreppWire Week in Review for week ending July 16th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, earnings season kicked off with the largest banks reporting strong profits, and Fed Chair Powell took some tough questions from lawmakers as inflation continued to accelerate last month. Unemployment dropped to a new pandemic low, and manufacturing showed continued strength despite supply and labor constraints. Manus, diving into what drove inflation, cars, hotels, women's apparel, airlines all seem to support the narrative that prices will ease as the economy opens.
Well, that certainly seems to be Fed Chair Jerome Powell's narrative, and he's sticking with it. I'm not sure what his demeanor was these last couple of days, if the right word is defensive or defiant. But he believes, he was a little bit more measured this time. He did say that there was more inflation than he had anticipated, but he was, defending that position that this is transitory and there's no need for the Fed to panic or taper any sooner than anticipated or raise interest rates. But as we know from Tuesday and Wednesday's data, this was a Buster Poindexter set of inflation reports, right? Ole, 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 ole. It came in hot, hot, hot. And CPI on Tuesday, PPI on Wednesday, much hotter than anticipated. If that's not inflationary, I don't know what is.
I think at this point, honestly, I just think at this point, the Fed would rather see the economy overheat than start raising interest rates right now. It almost feels, I've said this many times, I've grown up in the working world economy post great financial crisis. And I just feel like they've become such a pawn they're so driven by the financial markets, and that, if the S&P drops 5%, the Federal Reserve feels like they have to come to the rescue or come out and say something about it, where maximum employment and 2% target inflation is what they're supposed to be doing. We did get some good unemployment claims numbers today, right? I think it was 316 or 360,000, something like that, which was the lowest it's been since COVID. Something like 14 million on unemployment, still 14.8, something like that. Again, that's also the lowest since the big run up in 2020. So we're clearly not at maximum employment, but we seem to be heading in that direction. And I don't know how you define maximum employment now when unemployment benefits are as high as they are and the child tax credits are kicking into people's bank accounts and things like that. So I think that Powell is trying to say whatever it takes to justify not raising rates for as long as possible at this point, for better or for worse.
I'll give two thoughts on this week's data. The first is that the markets really shrugged it off, right? These were really significantly higher inflation readings, CPI and PPI this week, than analysts had expected. And a couple of months ago, this was the type of thing that would lead to a sizable stock market sell-off. We didn't see any of that this week. To be sure that it was, some wobbliness. The markets ended flat a couple of times. They lost a little bit of ground, but there was no panic in the market. So clearly, for the time being, investors are putting their faith in the Fed, that their narrative and their belief and what they're seeing, all of those things are helping boost investor confidence. But when it comes to the posture, let's put it the posture of the Fed this week, there was very much this image of Jerome Powell giving off this vibe of, I've got this. Don't worry, investors, I got this. And when it's Mark Messier or Joe Namath or Cedric Maxwell or Michael Jordan or Jimmy Chitwood, right? And they say, I got this, you kind of believe it. But I'm not so sure with the Fed. I'm not sure they got this. I think that inflation will continue to surprise to the upside. And at some point, I'm not a guy that pours over inflation data, but it just feels like things are heating up fast.
Don't get caught watching the paint dry.
That's right.
Trepp just released a report diving into financial benchmarks by property sector to assess the impact of the pandemic. What does it look like?
Yeah, so this is actually a really dense numbers-wise and data-wise report, so definitely worth picking up. we had about half of the universe of CMBS so far has reported 2019 and 2020 full year financials. So it was about 13,000 CMBS loans, a little more than half of the universe. And we did an analysis of their year over year change in revenue, net operating income, net cash flow, expenses, and occupancy. And a couple of data points to throw at you. So all lodging, all different subtypes of lodging, minus 70.5% in NOI year over year from 19 to 20. Occupancy down 36%, revenue down 45%. And now if you break it down into the different property subtypes within lodging, full service NOI down 95%, extended stay down 49. So those are kind of two ends of the barbell there, with limited service in the middle at 67% down. So a couple of the other property types, multifamily, about 2% up on the NOI, but mid, high rise and senior living were negative. So I kind of look at that and think those are the large city, central business district multifamily type properties. And obviously senior living, there weren't a lot of people moving seniors into senior living facilities during COVID. On the retail side, we have a lot more kind of differentiation among subtypes, but overall, the numbers aren't that bad. Overall, it's minus 5% on NOI for all retail. And if we're looking for positives in the data, drugstore was actually flat. Power center, surprisingly, only down less than 2%. But the big drops were in super regional mall, urban/street retail, regional mall, what you would expect. Those are 17, 16, 13% down in terms of NOI. Looking across the entire universe, all property types, NOI down 10% across everything. So given everything that's gone on and everything that, we've gone through over the last year and a half, down 10% across the board, with probably cap rates that are flat and even maybe compressing a little bit. That's not the worst number in the world. The last part I will talk about here is occupancy. So in the multifamily space, that mid-high rise, some of the ones that stand out to me is that mid-high rise subtype, average occupancy down from 95 to 88. Senior living occupancy down from 93 to 89. Everything else is kind of aligned with what we were talking about on the NOI side. Extended stay had the least bad drop in occupancy from 78 to 58, and full service had the worst from 73 to 38. And the last numbers I'll throw at you before you all fall asleep on me is overall lodging average occupancy was down from 75% to 48%. And all the other property types were relatively flat if you're looking at them on the overall basis. Industrial up slightly, multifamily down a couple basis points, office down 2%, and retail down 2%.
So the numbers really underscore everything we thought we would see based on our anecdotes over the last year. It really does tether quite finely to what we thought we would see, right? Street level retail being a problem, regional malls being a problem, hotel occupancy being a problem. All of that really fits what we would have expected to see. The one additional thought I would throw in there, Joe, you were talking about a 10% dip in NOI overall and about a 50% dip in occupancy for hotels. I should add that theoretically, this is not the worst of it, right? This covers all of 2019 and all of 2020. But the first 3 months of 2020 were pretty good, right? Until the second half of March. So you had 2 months in there that were okay before things started really going south. What would be interesting, and I'll see if our analysts can do this in a month or two, is to see how 3/31 to 3/31, 2019 to 2020 compared to that same year, 20 to 21. Because then you'd be really talking about 12 months of just eviscerated hotel performance, right? And I think that 38% drop probably comes more like 42%, 48%, something like that. But regardless, the numbers in certain of these submarkets are quite stark.
So let's break down by property sector some of the news we've seen in the last week or two. Manus, why don't we start with hotels?
So we like to point out some green shoots that are out there. I'll start with one. This is about a week old. We didn't get to sneak this into last week's recording. The Apollo Group purchased the Mayflower Hotel in Washington, D.C., or at least a share of that hotel. The hotel itself is a nearly 600-room property on Connecticut Avenue. It dates back to 1925. The story comes from the Commercial Observer, and I thought it was interesting. Some of the who's who have stayed at the hotel included Winston Churchill and Amelia Earhart. Who's whom? Well, actually, in the article it says who's who. So I'm not sure if I believe you, Joe, or the editor of Commercial Observer. But Winston Churchill, Amelia Earhart, John F. Kennedy, and J. Edgar Hoover among the dignitaries that stayed there. So we like this, right? This is a nice property sale that shows that people are coming back into that particular industry. Any sale in the hotel market is a good sale by me these days. Another one we have, I'll call this one the deal of the week. Veterans Services USA bought a hotel portfolio for $225 million. They teamed up with Lockwood Asset Management to buy 10 hotels totaling 1.6 million square feet. The organization plans to redesign and convert these buildings into properties that will serve veterans 55 and over. So I love this story for several reasons. One, it's 10 hotels that were sold, which is great. It shows that that market continues to open. But I also like the fact that any group that is out there trying to provide services for veterans in this country, I think, deserves for us to really root for them. Eddie Neverez of Marcus and Millichap was the agent for Veterans Services USA and Lockwood for 9 of the 10 properties, which I think included a bunch of Crown Plazas, if I'm not mistaken. So those are the 2 happy stories that we had about that. 2 stories that were kind of mixed bags, both in Houston. We've talked about Houston hotels for quite some time. There was a rash of events where borrowers were throwing back the keys on Houston hotels last year, thinking they couldn't make a go of it. I think we had somewhere between 6 and 12 stories to that effect. This month, 2 loans came in with lower valuations. One was a happy surprise. One was more of an expected result. The first one, the Sheraton North Houston. This is a 419-key full-service hotel. The property was renovated in 2015. The owner indicated a willingness to return the collateral several months ago. The property was valued at $68 million in 2016. This month, the value was lowered to $56 million. And that's the happy surprise, that there's still almost $20 million in positive equity in that hotel, if you believe that valuation. As I said, the collateral balance itself, $37.3 million. So this may have a happy ending. This may have the kind of thing where that loan gets largely paid off in full. This is a property for which occupancy was 56% for the 12 months ending in September 20, and DSCR was 0.64. The other one was a little bit more run-of-the-mill. This is the Crown Plaza, Houston River Oaks. Here, the borrower, again, had requested a deed in lieu. The borrower at one point had offered an $11 million number and a $13 million number on a loan that had a $23 million balance. This month, the value was lowered to 18.5 million. So in this case, mixed bag. The value is below the loan balance by about 5 million, but it's certainly well above what the borrower had offered in DPO proceeds a couple months ago. So a couple of Houston stories we're watching.
Yeah, I should point out that report I was talking about before does break down the growth or negative growth in NOIs and revenues, et cetera, across, I think we did the top 25 cities. But the point is, the cities and areas that did least badly, or best, I should say, are places like Vegas, Dallas, Houston, actually, Jacksonville, Fort Worth, Phoenix, San Antonio, et cetera. So not too surprising. We had a Tucson in there as well. So someday I'd like to go to Tucson, but that kind of aligns with not as bad as it could be, I guess.
So at the risk of revealing my grammar nerdiness, it's who is who when you can replace the word with he or she.
I know. And if you can replace it with him or her, it's got to be whom. What about whomst? I just thought who's whom is kind of a funny sounding way of saying it.
Yeah, but wrong. So let's turn to retail.
So retail, we didn't have a whole lot this week. We were about halfway through, as Joe said, the remittance cycle. There were a couple of retail properties that didn't pay off at their balloon date and so forth, but we'll give some more updates on those next week. The one really interesting story that we saw was a Buffalo mall was sold for less than its most recent valuation, which is a disappointment to be sure, but there was a little bit of intrigue behind the sale that probably makes it even more disappointing for CMBS investors than it might otherwise be. So the mall in question here is the McKinley Mall. It was sold this week, or recently, I should say, for $8.5 million to Cohan. We've mentioned Cohan in the past. They are buyers of distressed retail properties. They've bought many several for under $20 million. Their business model seems to be to keep running these as malls. Spectrum Local News in upstate New York reported this story. So this is disappointing for CMBS investors on two levels. Level number one, the collateral was valued at $11.5 million late last year. So the 8.5 is 30% less than what a valuation had been a couple months ago. So that's disappointing on its own. But separately, there had been interest from Benderson Development and the town of Hamburg to try to stop the sale. Benderson is a owner of some of the out parcels at the mall. I think they own the Macy's parcel in the mall. They said that they would have been willing to pay $10 million for the asset, but they were unable to reach the broker in time to make this purchase. They went to court to try to stop the sale. They were unsuccessful. So the $8.5 million sale to Cohan goes on. This particular property or this particular loan had two pieces. The total balance had been about $32 million. So you can expect a loss of 26 million on this. The two pieces are split between two 2014 deals. And as I said, it's a disappointing outcome for CMBS investors in those two deals.
I'm interested in the Cohan business, I guess their cost basis is so low that they're happy to operate it and, make money on the cash flow and try and figure out what to do with them at a later date.
Well, look at it this way. For a lot of these malls, occupancy had been, let's say 96%, and now it might be 84%, right? So maybe it's lost 12% of its tenant base, and maybe NOI, or debt service coverage ratio, has gone from maybe a 1.6 to a 1.2 or a 1.0, right? So that's dropped by a third, yet they're picking up these malls for 20 cents on the dollar. This mall was valued at $56 million 5 years ago. They're picking it up for 8.5. So the numbers should work, right? They should be able to get a strong return on investment as long as they can hold that tenant base where it is, right? It should be generously cash flow positive.
Seems to be the only place in the market that I can see that we hear about where there are actually deals getting done at pennies on the dollar.
That's really true. We're not seeing a whole lot of distress at this point, and certainly not deep discounts. I think we saw a couple of hotels that were resolved for losses of 40 and 50%, but those tended to be oil patch, right? Texas, Louisiana type things, small properties, loans of $10 million or less, but not a whole lot.
So yeah, one more thing to mention on retail, more kind of macro and micro. There was an article in Bloomberg this week about Starwood Capital. They've been on a selling streak in terms of their mall properties. They had, according to this article in Bloomberg, they had 30 malls before COVID, and now they have 8. A couple lines here. So Mark Deason, a Starwood managing director, said in a statement, with further deterioration caused by COVID, committing substantially more capital required to successfully position many of our assets became unviable at our existing cost basis. This is, we've been seeing this, and this is, going to continue to be a story because Starwood is a big tapper of CMBS debt. So one other thing to mention here, this is not a Starwood person. This is somebody else. This is head of real estate research for DWS Group. We might have to have this guy on. He's Kevin White. The very best quality malls will continue to survive and thrive, but that's probably 20 to 25% of the mall universe. All of the rest will have to be reconditioned into some other use. Sounds like, we're Groundhog Daying it again here, saying the same thing over and over, but it's just kind of more confirmation of that story. So check out that's a decent story in Bloomberg. They go into a little bit more detail on the background of Barry Sternlicht and Starwood as well.
Turning to office, Joe, you did some analysis on office maturities. You've been busy this week, actually.
Hey, look, every now and then I have to contribute something to this podcast other than jokes.
What were some of your findings?
So, this is preliminary. It's all in a spreadsheet right now. I've been kind of pulling together numbers the last day or two. And, we've been telling this story or having this hypothesis of this slow leak in the office market. The fact that we haven't seen big delinquencies, we haven't seen big drops in occupancies or anything like that. But I think I should say, there has to be a real shakeout that occurs due to COVID and due to the 3-2 work week. And even if everybody comes back to work, there are a lot of people that are going to be staying home a day or two a week and that type of stuff. And there's going to be a shakeout, right, in terms of what landlords can charge and or kind of the leverage that the tenants have, right? So I wanted to just take a look at some data in our world, and a couple of points here. I've basically looked for office loans that are maturing between now and 2023, the end of 2023. I also removed all delinquent loans. So I'm not thinking about loans that are already in trouble. And the total amount that I found was about just under 12 billion of office balance that's going to be maturing over the next 2.5 years. And then I looked at the percentage of their underlying tenant roster that would also be rolling before the end of 23, right? So basically you're maturing between now and December 2023, and you have what percentage of your kind of property is going to be either extended or re-tenanted between now and then. And of the 11.7 billion or so maturing between now and 2023, 26% by balance have at least 30% of their square footage rolling in that time frame. Now, maybe that's not that big of a number. Maybe that's reasonable, but some of the numbers kind of at the higher end, 1.3 billion or so, or about 12% of the total maturing, have at least 60% of their space rolling, right? And then we've got about 800 million in office properties that are maturing that have their entire tenant roster. Maybe it's a single tenant or, multiple tenants that make up 100%. So about 800 million. If I was a tenant rep, I would be looking at this list and calling up these tenants and saying, you had leverage due to COVID, and now you have even more leverage because this landlord's going to want to renew this lease so that he can refinance this loan. So we might put something together research wise, but I just wanted to kind of see the magnitude of it. It's not a huge number in terms of the total balance. I mean, I think it's probably 10 to 15% of the outstanding office conduit market is maturing in the next 2 years. So it's not like a huge thing, but these are billions of dollars that are at stake in terms of refi And so there's going to have to be a lot of negotiations to re-tenant these spaces or to renew leases.
You know, the story is not really a theoretical one. We've seen this over and over again over 25 years, stories about single tenant or dominant tenants in big offices in various cities, right? We've seen it in central New Jersey. We've seen it in St. Louis. We've seen it in Chicago. We've seen it in the Chicago suburbs, right? Big firms getting up, moving their locations, leaving a property largely obsolete, ending with a 7, 8, or 9-figure loss. And for investors that, you know, play in the sub AAA stack, right, single A down to unrated, right, this is the kind of stuff that savvy risk managers will get their arms around before it happens, because a lot of times the clues are there.
Yeah, so some of these are probably a little less worrisome. I'm just looking, I mean, we've seen that binary risk, right, in office, and just looking at, you know, sorted by percentage of tenants rolling and by balance, a lot of the office buildings that I see here are government office. So I see like Dallas FBI, I see Winchester FEMA, I see GSA building, DEA Milwaukee, and so on and so on. So those are the types that you can probably check off the list of ones to worry about too much. But there's still, you know, you've got 360 Park Avenue, you've got General Motors, Innovation Center, you know, Anthem Health, like these types of places where one stroke of the pen, you know, from a CFO or from a corporate real estate guy could really move the market.
I think the GM Innovation Center, I think that one, if I'm not mistaken, they've already flagged that they are going to be vacating, if I have my facts straight.
So continuing on office stories, we're going to take a tour through some major metro areas to cover some hot stories.
So this, let's call this the grab bag of the week. Back in May, we mentioned that the Townsend Group was selling 90% of its stake in the Citigroup Center to Monarch Alternative Capital for $300 million. This month's remittance data revealed that a big 2012 loan on the property has been defeased. The loan itself was almost $150 million. It was known as the Miami Center loan, split between two 2012 deals. The property has almost 800,000 square feet. Why does this matter? This matters because a big part of that loan is part of CMBX 6. So we talk a lot about CMBX 6 having mall exposure, loss exposure, you know, the potential for BBB minus buyers, holders to suffer losses. But on the other side of this, you have positive stories that take place periodically. And in this case, this loan was defeased, meaning the collateral is no longer an office, which could potentially or theoretically have defaulted. It's now US Treasuries. So that element of risk is now gone. And it's one fewer loan in the CMBX 6 universe that could potentially default and put at risk BBB minus paper in a CMBX 6 deal. So not that anybody is really expecting offices to blow up, but that is, you know, the other side of the mall coin. And that's why it's so hard sometimes to get your arms around the CMBX 6 trade. It's not just retail. Other things we are looking at this week, a big New York City office went to special servicing. This is 750 Lexington Avenue. It backs a $129 million loan. Special servicer comments were sparse, noting only that the loan was facing imminent monetary default. The loan is 30 days delinquent as of July. The property is a 31-story Class A office in Midtown Manhattan, almost 400,000 square feet. In 2020, DSCR was 1.15x when occupancy was 86%. A couple of years ago, they lost a big law firm that put some pressure on occupancy. Lord Locke vacated 31% of the space. But what's probably adding some concern right now is that WeWork took 20% of the space on a 15-year lease in 2018. So we don't know this for sure, but it could be that WeWork story, which is putting pressure on that particular loan.
That WeWork lease is 22% of the space. right now.
Not insignificant for sure. A couple of other happy stories. Raytheon re-upped its lease in Northern Virginia. That comes by way of the Biz Journals. The San Francisco Chronicle was reporting today that Twitter plans to expand into Oakland. They're going to take a 65,000 square foot lease on Broadway in that city. Listeners may recall that a couple months ago, Twitter said that they were going to let people work permanently from home, those in their San Francisco office. So the fact that they're expanding in Oakland seems to be an interesting twist. In downtown Orlando, Wells Fargo signed a 7-year lease renewal for 82,000 square feet at One Orlando Center. That's also known as the Wells Fargo Building on Magnolia Street. Throw some credit there to David Privé of Cressa Partners, who represented Wells Fargo, and John Gilbert of JLL, who represented the landlord, which is Parkway Properties. Why do I like this deal? I like it because, you're never quite sure if banks are going to downsize when their leases come due. And in this case, Wells Fargo re-upped for more than 80,000 square feet. Good on them. In Atlanta, Novellus is downsizing. It has 125,000 square feet of space at 2 Alliance. It's moving to a new development in Buckhead. That comes from News Nation USA. And our must know of the week. This comes from the Baltimore Business Journal. Pandora Jewelry is putting its Baltimore headquarters space up for sublet. And why does that matter? Well, we've mentioned over and over again that downtown Baltimore is filled with properties that are either vacant or will shortly become vacant. The state of Maryland was talking about moving office workers down there just to help fill that space, which has become a little bit of a problem in terms of its extraordinarily high vacancy rate. And now here you go with Pandora Jewelry making another 90,000 square feet available at 250 West Pratt Street.
It reminds me of, there was this jewelry store in the town near where I grew up called Pennyweights. And that's where me and my buddy used to go before every girl's birthday party. You know what I mean? Like in grammar school, girl would have her like 13-year-old birthday party, and you'd go to Pennyweights and you'd buy a necklace for like, $17.50. And you'd feel like king walking into that party, right? With the fancy box and the wrapping and everything else. Those boxes have turned blue over the years and gotten much more expensive, but
That's a different.
I can still dream and remember.
And they're cheap enough to, leave a stain on the recipient's wrist. Is it that kind of, low quality metal? Back in the day for me, if you didn't have a whole lot of, extra cash, and we rarely did in my family, the go-to gift was the 45 record, Peaches and Herb Reunited or something like that. And if you really like the girl, or if you somehow found $5 on the street that day, maybe you'd go for the LP, right? Something, from the Beach Boys or Paul McCartney or something like that. But that was few and far between
That
the
is
LPs.
super retro right there.
Pet Sounds, one of the greatest albums of all time, in my opinion.
I can't argue with that.
Good
Whatever
vibration.
happened?
Like
whatever
3 songs
happened
in
to,
one.
The little thingamajig that you used to use for 45s to play them on your turntable.
Now they, they're under my desk, keeping the,
Keeping your feet up.
Keeping the one leg, which is a little shorter than the other 3,
Propped
from
up.
tipping the whole desk over and impacting the quality of the podcast.
Oh my gosh.
45's the new matchbook.
Yeah, right. Exactly. So we talked about earnings at the top of the podcast. They were released and the largest banks had some good results, but investors did not seem to be very impressed.
Yeah, takeaways here. I mean, not a lot to talk about, right? Everything that we would expect. The fixed income trading and the equity trading desks came down off of their massive highs from last year. The kind of equity underwriting, the SPAC stuff, the IPO stuff, still really, really banner quarters for JP Morgan and the other big banks. But in general, the top 4 or 5 banks revenues were flat to slightly down, and earnings were way up. And most of that was due to the fact that they're continuing to release loan loss reserves at a rapid clip. They built up massive reserves at the beginning of 2020 when COVID hit and CECL hit. And since then, they've been releasing them little by slowly, but it's not that little by slowly when you're releasing a couple billion every quarter.
So let's turn to shoutouts. BB Dogged Tenacity, a repeat shout out, is actually asking for the gift card that we offered up a couple of podcasts ago. And I think we're going to have to make good on that promise.
He's going to have to come out from his anonymity, though. So I don't know if that's going to happen unless he gives us like a P.O. box or something.
Yeah.
He has his choice of a movie ticket or a gift certificate to the last Blockbuster. The only downside to that is he has to go to Bend, Oregon to stake his claim to a movie or two.
Yeah. Does
He
it
also has to
include
go buy a VHS.
Does it include
video
travel and
player.
expenses? He also asked a couple questions about the delinquency rate and if more loans are current because of forbearances or other modifications.
I would say in answer to that question, if he had asked that question 8 or 9 months ago, I think the answer would have been yes. We were really right in the middle of the forbearance process. There were a lot of loans that were current because of the use of FF&E reserves in the hotel space, but hadn't made a payment in quite some time. I think that has really tapered off considerably. I don't think there's many left. I don't know that for sure what that number is, but I think that the percentage of loans that are still in forbearance with the borrower using a reserve and not making a cash payment every month is de minimis at this point. It wasn't de minimis, in 2020. I think at one point we thought it might have been 2 or 3% of the delinquency rate, but or 2 or 3 points higher the delinquency rate would have been had we counted those as delinquent. But I think that's been squeezed out of the system.
So BB, send us your address and we will hook you up with the gift card we promised.
Can we throw in Fink as a guest? Tom Fink as the the movie
People
reviewer.
come to your house and sing you like a barbershop quartet song.
And we had John D comment on episode 90. He's in the United Capital Markets organization as a CMBS broker dealer, listens to all the podcasts, loves the insights. And Chris M actually sent us what we are adding as another deal of the week based on the information he sent.
Yeah, so Chris Mailing from Avis & Young sent us a very good and bad deal of the week. Sunset Plaza Mall in Norfolk, Nebraska, which I've been told is...
Norfolk.
Which we've been told from Martha, who lived in Nebraska for a while.
Nebraskans say it like it's Norfolk because, well, that's how they refer to North Fork.
So anyway, the Sunset Plaza Mall was an REO loan in a CMBS deal. It's been sold. This guy, Chris Mailing, who emailed us, he's with Avis & Young. He represented the seller, Citus, and also procured the buyer, Brookwood Capital Advisors. They closed just a couple of days ago. This loan actually is still outstanding. It is a $6.8 million loan, amortized down from 9.8 or so at securitization. It was done back in 2012. It's part of a COM 2013 CR7. There was some watch list commentary over the last few months talking about how the property was for sale and how they had received some offers, but really cool to see something full circle from the boots on the ground. So thanks, Chris, for pointing that out.
And Dan McNamara, a guest and a listener, shared our monthly loss report on Twitter. So thanks, Dan, for doing that. Brian B. forwarded an article in the Minneapolis St. Paul Business Journal, and it was focused on the Mall of America suing a number of tenants for back rent. I think 11 is the latest tally of lawsuits there. Matt O reached out with a question of comparison of CMBS versus CLO spreads, and we sent him that answer. And at Michael MBA on Twitter, who is a long time Twitter follower of Trepp, actually shared our year-over-year financials analysis. So Michael MBA, good to hear from you after a long time.
Michael MBA, he used to be one of our biggest engagement guys on Twitter and email and everything else back in the day.
Yeah.
Good to hear.
Yeah.
I don't spend a lot of time on Twitter. I did it one time for a very short time, but I don't anymore. But I did find Michael's stuff on Twitter to be very informative. I thought he really covered the market, and he was one of the first ones in CRE to do so. So a lot of really thoughtful commentary used to come from him.
Twitter can be an absolutely amazing place for really interesting, informative, almost educational content. And it can also be an epic cesspool hellhole. It just depends on how you curate your follower or who you follow, whom you follow.
Yes.
Thank you very much. And I'm probably about 65% good educational real estate, financial Twitter, and then 35% down in the mud. So, I go back and forth.
So I'll give one more shout out. I tend to meander with these shout outs, as people know from the past. We've talked about first responders and waiters and waitresses, hotel workers, doctors, nurses, etc. This is a shout out that will be heard by exactly no one, but I'll shout it out nonetheless. This is to the people of Cuba, that I hope that, their protests are not met with overwhelming violence and that more freedom comes their way. I'm incredibly simpatico to the people on that island right now that are really fighting for their lives courageously.
Cuba Libre. So, speaking of Cuba, I'm going to warn you guys that coffee, and by the way, Cuban coffee is probably the best coffee there is out there. I'm just going to say that.
You're
Coffee,
biased.
Yeah, a little bit. Coffee prices are climbing as a result of one of the worst droughts in Brazil in nearly a century. And it seems that other countries that supply coffee to our country, Colombia and Vietnam, are struggling with port delays. So the supply chain is causing a backup in our Java supply. So if you're smart, you might want to stock up.
So this is a funny thing, isn't it? That let's suppose we take this to its logical conclusion and we do start running out of coffee. Does that mean there's going to be really lethargic mobs of people on the street, like tapping on windows really slowly, hoping, that somebody will hear their pleas for help, right? This is not going to be like an angry mob, people with pitchforks, right? This is going to be people like rubbing their eyes, still in their bathrobes, thinking, slothfully moving through town saying, help me, help me.
It sounds like a zombie apocalypse. Slow moving people that somehow catch up to their victims. And on that note, we got to go. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com. For more information, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.